September 15th, 2008, 1:45 in the morning. The headquarters of Lehman Brothers, situated in Times Square, Manhattan. Dick Fuld, the chief executive officer of Lehman Brothers, stood in his office on the 31st floor, gazing out at the metropolis that never truly rests. Outside, media crews were assembling their equipment, and journalists were arriving. The entire world seemed to be anticipating an event. In a mere few hours, Lehman Brothers, an institution that had endured for 158 years, having weathered the Civil War, 2 global conflicts, and the Great Depression, would formally declare bankruptcy. This bankruptcy would stand as the most significant in American history. With $639 billion in assets and $619 billion in liabilities, 25,000 employees faced the loss of their livelihoods. The global financial framework would grind to a halt. Stock exchanges would plummet. Banks worldwide would teeter precariously, and the Great Recession, the most severe economic downturn since the 1930s, would commence. However, it is crucial to grasp this. Lehman Brothers did not falter due to sheer misfortune. Its downfall stemmed from a system meticulously crafted to obscure risk, incentivize recklessness, and shift the repercussions of decisions away from those who made them and onto everyone else. And this very system did not disintegrate when Lehman collapsed. It expanded. What precisely transpired at Lehman Brothers? How did a firm that had persisted for over a century unravel in less than a year? Who foresaw this impending disaster? Who possessed the ability to avert it? And why did the government permit its failure when it had intervened to rescue other financial institutions? Allow me to guide you through its ascent, its arrogance, the ignored warnings, the agonizing final weekend, and the precise moment when everything irrevocably broke. Because understanding Lehman Brothers is not solely about comprehending the events of 2008. It's about deciphering the mechanics of today's financial system and anticipating why the next crisis might prove even more devastating. Prior to becoming a symbol of financial ruin, Lehman Brothers was recognized as one of Wall Street's most esteemed names. The enterprise was established in the year 1850 by 3 brothers who had emigrated from Germany, Henry, Emmanuel, and Mayer Lehman, in Montgomery, Alabama. They began their journey as cotton merchants, procuring cotton from southern plantations and supplying it to textile manufacturers. Following the Civil War, the brothers relocated to New York and transformed their business into an investment bank. For the subsequent 150 years, Lehman Brothers provided financing for some of America's most recognizable corporations. They underwrote the initial public offerings for entities such as Wanamaker's, Macy's, and subsequently, in the 1990s, technology firms, a period of immense growth. By the year 2000, Lehman Brothers ranked as the 4th largest investment bank in America, trailing only Goldman Sachs, Morgan Stanley, and Merrill Lynch. The company employed 25,000 individuals across 40 nations and managed trillions in assets. And it was on the precipice of a decision that would annihilate everything. In the latter part of the 1990s, Lehman Brothers derived the majority of its revenue from conventional investment banking activities, underwriting stock offerings, advising on mergers and acquisitions, and managing the portfolios of affluent clients. It was a profitable, albeit unexciting, business. The returns were consistent but unremarkable. Then, the dot-com bubble burst in 2000. The stock market experienced a dramatic decline, and investment banking revenues plummeted. Lehman Brothers urgently required a new strategy, which it discovered in the real estate sector. In the year 2000, Lehman Brothers began a significant expansion into mortgage lending and the creation of mortgage-backed securities. They were not merely financing mortgages, they were acquiring mortgage companies, consolidating mortgages into securities, and trading them for substantial profits. By 2004, Lehman Brothers had become a dominant force in the mortgage market, and the profits were truly staggering. In 2005, Lehman reported a net income of $3.3 billion. In 2006, this figure reached $4 billion. Dick Fuld, the chief executive officer, ascended to become one of Wall Street's highest compensated executives, earning over $40 million annually. Yet these immense profits were not derived from traditional secure mortgages. They originated from something far more perilous: subprime mortgages. To comprehend the factors that led to Lehman Brothers' undoing, it is essential to understand the housing bubble and the role of subprime mortgages. In 2000, the Federal Reserve, under the leadership of Alan Greenspan, responded to the dot-com crash by aggressively lowering interest rates. By 2003, interest rates had fallen to 1%, the lowest in 45 years. This made borrowing exceptionally inexpensive. The availability of cheap credit enabled more individuals to qualify for mortgages. Increased demand for housing subsequently drove up property values. As home prices climbed, existing homeowners felt wealthier. They leveraged their home equity through borrowing and increased their spending. During this period of economic expansion, everyone appeared content. However, a more unsettling trend was unfolding beneath the surface. Banks were encountering a shortage of qualified borrowers. In a conventional housing market, financial institutions extend loans to individuals possessing sound credit histories, stable incomes, and adequate down payments. These are categorized as prime borrowers, representing a low-risk demographic. But by 2003, most prime borrowers who desired a mortgage had already obtained one. Consequently, banks began to extend credit to subprime borrowers. These individuals often had compromised credit scores, unpredictable income streams, and lacked the necessary down payments. In any rational financial system, they would not have qualified for a mortgage. Why would banks engage in such practices? Because they were not retaining these loans. Here's how the mechanism operated. A mortgage company would issue a loan of $300,000 to an individual who could barely afford the repayment obligations. The borrower would sign the mortgage agreement and the monthly payments would commence. However, the mortgage company would not keep this loan on its own books. Instead, it would sell the mortgage to an investment bank, such as Lehman Brothers. Lehman would then acquire thousands of these mortgages, aggregate them, and create a mortgage-backed security, or MBS. This security would then be sold to investors globally. Pension funds, insurance corporations, and foreign governments all purchased these mortgage-backed securities because they offered higher yields than government bonds. The mortgage company profited from origination fees. Lehman profited from packaging and selling the securities. And the investors received what they believed to be secure, high-return investments backed by American real estate. Every party in this chain profited, yet critically, no one bore the risk. The mortgage company had no vested interest in the borrower's ability to repay, as they had immediately sold the loan. Lehman had no concern, as they had offloaded the securities to investors, and the investors, in turn, were unconcerned because the credit rating agencies, Moody's and Standard & Poor's, had assigned these securities R ratings, the highest possible safety classification. The fundamental flaw, however, lay in the fact that the mortgages underpinning these securities were fundamentally unsound. These were subprime mortgages, often issued without income verification. They included adjustable rate mortgages with terms that would escalate to unaffordable payment levels after only 2 years. Loans were provided with zero down payment requirements. Mortgages were extended to individuals who had misrepresented their financial situations on their applications. These were commonly referred to as ninja loans: no income, no job, no assets. And these were being packaged into securities rated with the same level of safety as United States Treasury bonds. By 2006, subprime mortgages constituted 20% of all newly issued mortgages in America. This amounted to $600 billion in subprime loans originated in that single year alone. And Lehman Brothers was a principal player in this burgeoning market. However, the situation deteriorated further. Lehman Brothers and other financial institutions proceeded to take these mortgage-backed securities and construct something even more intricate: collateralized debt obligations, or CDOs. A CDO involved taking the most precarious tranches, the subordinate slices, from multiple mortgage-backed securities and repackaging them into a new security. In essence, the riskiest mortgages, those most prone to default, were bundled together, further sliced, and astonishingly, The senior tranches of these CDOs received investment-grade ratings. This was akin to financial alchemy, transforming speculative assets into seemingly secure investments through sheer complexity. Investors worldwide acquired these instruments because the ratings indicated safety and the yields were attractive. By 2007, Lehman Brothers held over $85 billion in mortgage-backed securities and CDOs on its balance sheet. This represented an $85 billion wager that housing prices would continue to rise and that subprime borrowers would consistently meet their payment obligations. Yet housing prices could not ascend indefinitely, and in 2006 they ceased their upward trajectory. The warning signs began to emerge in 2006, but virtually no one paid heed. Home prices reached their peak in the middle of that year and subsequently began to decline. This represented an unprecedented event in modern American economic history. National home prices had historically always appreciated. While individual markets might experience downturns, the overall national market had consistently risen, up until 2006. By early 2007, subprime borrowers were defaulting at alarming rates. Adjustable rate mortgages were resetting to higher payment amounts that borrowers found impossible to afford. Foreclosures escalated, and the mortgage-backed securities held by Lehman and other institutions rapidly diminished in value. In February 2007, HSBC, one of the world's largest banking institutions, disclosed substantial losses stemming from its subprime mortgage portfolio. In April 2007, New Century Financial, a leading originator of subprime loans, filed for bankruptcy. These were clear indicators of trouble, yet Wall Street largely ignored them. Lehman Brothers, too, disregarded these signals. Dick Fuld, the CEO, assured investors that the subprime crisis was contained, characterizing it as a minor issue confined to a specific market segment, and downplayed any cause for concern. By the summer of 2007, the crisis had begun to spread. Two hedge funds managed by Bear Stearns, another investment bank, collapsed due to losses incurred on subprime mortgages. In August 2007, BNP Paribas, a prominent French bank, halted withdrawals from 3 of its investment funds, citing an inability to accurately value the mortgage securities held within them. The market for mortgage-backed securities had effectively frozen. No one was willing to purchase them, and their true worth became indeterminate. Credit markets seized up. Banks ceased lending to one another, as each institution was uncertain about which counterparties held toxic mortgage assets. The Federal Reserve was compelled to inject liquidity into the banking system to prevent a complete paralysis. Lehman Brothers reported record profits in 2007, amounting to $4.2 billion. However, behind closed doors, executives were experiencing significant anxiety. The firm had extensive exposure to real estate, mortgages, mortgage-backed securities, CDOs, and direct investments in commercial property. Should the market continue its downward trend, Lehman would face catastrophic losses. In late 2007, Lehman's chief risk officer, Aaron Callan, alerted senior management to the company's excessive real estate exposure and recommended its reduction. Her counsel was dismissed. By early 2008, she was removed from her position overseeing risk management. Other executives voiced their concerns, only to be instructed to remain silent. Dick Fuld maintained the belief that the crisis was a temporary phenomenon, and that Lehman could weather the storm. He was convinced that housing prices would eventually rebound. He was mistaken. On March 14, 2008, Bear Stearns found itself on the brink of collapse. Bear Stearns was the 5th largest investment bank in America and, much like Lehman, held substantial exposure to mortgage-backed securities. Bear's stock price had plummeted from $170 per share a year earlier to $30 per share, and it was poised to reach zero overnight. Bear Stearns relied heavily on short-term borrowing to fund its day-to-day operations. Each day, it would borrow billions in the repurchase agreement market, utilizing its assets as collateral. On March 13th, Bear's lenders refused to renew these loans, leaving Bear Stearns critically short of cash. Without emergency funding, Bear Stearns would be forced to file for bankruptcy. The following morning, the Federal Reserve, under the direction of Chairman Ben Bernanke, and the Treasury Department, led by Secretary Hank Paulson, faced a critical decision: allow Bear Stearns to fail or orchestrate a rescue. They opted for the latter. The Fed provided $30 billion in financial assistance, and J.P. Morgan acquired Bear Stearns for $2 per share, a price later adjusted to $10. While Bear Stearns' shareholders were effectively wiped out, the firm itself did not completely collapse. The financial system was thus shielded from a potentially catastrophic meltdown. Dick Fuld at Lehman Brothers observed this rescue and drew a significant conclusion. If the government had intervened to save Bear Stearns, it would undoubtedly do the same for Lehman Brothers if necessary. This established an implicit guarantee. Major banks were considered too significant to fail. The government would not permit a prominent investment bank to collapse. However, Fuld fundamentally misjudged the situation. The Bear Stearns rescue had been met with considerable controversy. Critics argued that it fostered moral hazard, encouraging financial institutions to undertake excessive risks with the expectation of a government bailout. Hank Paulson, the Treasury Secretary, was acutely aware of this criticism and was determined that the next significant bank failure would not result in a government-funded rescue. Following the Bear Stearns incident, Lehman Brothers was afforded 6 months to rectify its financial predicament. 6 months to raise capital, divest assets, mitigate risk, or secure a merger partner. In essence, 6 months to salvage itself. Lehman Brothers failed to execute any of these objectives effectively. In June 2008, Lehman announced a second-quarter loss of $2.8 billion. The company wrote down $5.6 billion in mortgage-related assets. Lehman's stock price experienced a 10% decline in a single trading day. Dick Fuld attempted to secure additional capital, reaching out to sovereign wealth funds, private equity firms, and any entity that might consider an investment. However, prospective investors examined Lehman's financial statements and perceived significant losses masked by accounting manipulations. They ultimately declined to participate. Lehman also attempted to sell off assets, including a stake in its investment management division. Negotiations with the Korea Development Bank regarding a potential acquisition yielded no results. Nothing proved successful. By September 2008, Lehman Brothers had run out of time. The company possessed $639 billion in assets but only $25 billion in equity. This represented a leverage ratio of 25 to 1, meaning for every dollar of equity, Lehman had borrowed $25. Such a high level of leverage becomes catastrophic when asset values diminish. Lehman's stock, which had traded above $60 per share at the beginning of 2008, had fallen to $14 by early September. Investors were rapidly exiting their positions, and clients were withdrawing their funds. Similar to Bear Stearns, Lehman's lenders in the repurchase agreement market were growing increasingly apprehensive. On September 9, 2008, Lehman announced a third-quarter loss of $3.9 billion. Its stock price plummeted by 45% in a single day, closing at $7.79 per share. Rating agencies issued warnings that they might downgrade Lehman's debt. Such an action would trigger immediate collateral calls that Lehman would be unable to meet, making bankruptcy an inevitable outcome. Dick Fuld spent that week actively seeking a buyer. Bank of America expressed preliminary interest, as did Barclays, a British financial institution. However, any potential acquirer would require government assistance. Lehman's portfolio of toxic assets was simply too substantial. A buyer would necessitate the government absorbing the associated losses, much like J.P. Morgan had received support from the Federal Reserve to acquire Bear Stearns. Fuld mistakenly assumed the government would provide such aid. He was profoundly mistaken. On Friday, September 12, 2008, Treasury Secretary Hank Paulson convened a meeting at the Federal Reserve Bank of New York. All the principal chief executive officers of Wall Street firms were summoned. Jamie Dimon from J.P. Morgan, Lloyd Blankfein from Goldman Sachs, John Mack from Morgan Stanley, Vikram Pandit from Citigroup, and John Thain from Merrill Lynch were all in attendance. Paulson's message was unequivocal. Lehman Brothers was on the verge of collapse. He presented two potential buyers, Bank of America, and Barclays, but firmly stated that the government would not provide taxpayer funds to facilitate a deal. If Lehman were to be rescued, Wall Street itself would have to bear the responsibility. This represented a stunning reversal of policy. Just 6 months prior, the Federal Reserve had provided $30 billion to assist J.P. Morgan in its acquisition of Bear Stearns. Now Paulson was declaring an absence of government financial involvement. The burden of absorbing Lehman's losses would fall collectively on Wall Street. The rationale behind this shift was primarily political. Paulson, serving as a Republican Treasury Secretary during the final months of a Republican administration, found the Bear Stearns bailout to be politically damaging. He recognized the impossibility of seeking congressional approval for funds to bail out yet another Wall Street institution. Furthermore, Paulson believed that allowing a major financial firm to fail would serve as a critical signal that the era of moral hazard had reached its limits. Consequently, he drew a firm line at Lehman. The chief executive officers of Wall Street firms spent Friday night scrutinizing Lehman's financial records. What they discovered was far worse than initially anticipated. Lehman held over $50 billion in toxic commercial real estate assets, whose actual value was significantly lower than Lehman's reported figures. The potential losses for any acquirer would be catastrophic. Bank of America, after reviewing the data, withdrew its interest, announcing on Saturday morning its intention to acquire Merrill Lynch instead. Merrill Lynch, the third largest investment bank, was also facing significant challenges, and Bank of America deemed it a more attractive acquisition target than Lehman. This left Barclays as the sole remaining potential buyer. Barclays was interested in acquiring Lehman, but British regulatory authorities insisted on a government guarantee for the transaction. Paulson refused to provide such a guarantee. By Saturday evening, the Barclays deal had collapsed. Lehman Brothers was without a buyer, the government had declined assistance, and the firm was critically short of cash. Bankruptcy was unavoidable. On Sunday, September 14, 2008, the board of directors of Lehman Brothers voted to file for Chapter 11 bankruptcy protection. At 1:45 in the morning on Monday, September 15th, the bankruptcy petition was officially filed with the court. 158 years. It had survived the Civil War, 2 World Wars, the Great Depression, and numerous economic downturns. And now it was gone. When Lehman Brothers filed for bankruptcy on Monday, September 15, 2008, it unleashed a seismic shockwave through the financial world that nearly crippled the global economy. Lehman's bankruptcy was the largest in American history, involving $639 billion in assets and $619 billion in liabilities. The bankruptcy filing itself comprised 900 pages. However, the sheer magnitude was not the sole issue. Lehman was deeply interwoven with the entire financial system. The firm had over 900,000 derivative contracts with counterparties worldwide. When Lehman failed, all of these contracts became uncertain, raising questions about who owed what to whom, and no one had the answers. Stock markets experienced a dramatic collapse. The Dow Jones Industrial Average plunged by 504 points on Monday, September 15th, marking the largest single-day point decline since September 11th, 2001. By the end of that week, the Dow had fallen by more than 1,000 points, but the most severe impact was felt in the credit markets. Banks ceased lending to each other. The commercial paper market, a crucial source of short-term funding for corporations, completely froze. Businesses were unable to access cash to meet payroll or pay their suppliers. The entire financial system was grinding to a halt. AIG, the largest insurance company in America, found itself on the precipice of failure. AIG had issued credit default swaps, essentially insurance contracts on mortgage-backed securities. With Lehman's bankruptcy, AIG faced immense liabilities. On September 16th, just 1 day after Lehman's collapse, the Federal Reserve provided an $85 billion loan to rescue AIG. The government had refused to bail out Lehman, but immediately intervened to save AIG. Money market funds, traditionally considered the safest place to store cash, began to break the buck, meaning their share value fell below $1. The Reserve Primary Fund, which held $785 million in Lehman debt, announced it could only pay investors 97 cents on the dollar. Panic spread rapidly. Investors withdrew over $300 billion from money market funds within a single week. On September 18, 2008, Hank Paulson and Ben Bernanke appeared before Congress to request $700 billion to bail out the financial system. Paulson warned congressional leaders that without this financial injection, the financial system would collapse within days, leading to the cessation of ATM operations, widespread business failures, and a plunge into economic depression. Congress initially rejected the bailout proposal on September 29th. The stock market plummeted by 737 points on that day, the largest single-day point drop in its history. Following this rejection, Congress reconsidered and ultimately passed the Troubled Asset Relief Program, or TARP, on October 3rd. However, even with TARP's passage, the adverse effects continued to propagate globally. Iceland's entire banking system collapsed. European banks holding Lehman debt incurred substantial losses. Emerging markets from Brazil to Russia experienced significant capital outflows. Global trade experienced a dramatic decline, signaling the onset of the Great Recession. In the United States, 8.7 million jobs were lost. Unemployment reached 10%. $16 trillion in household wealth was obliterated. Housing prices declined by 30% nationally, and in some regions by as much as 50%. It would take until the year 2014 for employment levels to recover to their pre-crisis figures. And it all began with Lehman Brothers. Following Lehman's collapse, accusations and blame were cast in every direction. Who bore responsibility? Who should have foreseen this outcome? Who possessed the capacity to prevent it? Dick Fuld testified before Congress in October 2008, enduring hours of intense questioning. Congressman Henry Waxman pressed him about his personal compensation. Fuld had amassed over $480 million between 2000 and 2008. He retained this wealth while Lehman's shareholders lost everything and 25,000 employees faced unemployment. Fuld defended his actions, blaming short sellers for deliberately targeting Lehman's stock price and criticizing the government for its decision not to rescue Lehman, especially after having intervened to save Bear Stearns and AIG. He pointed to the press as the instigator of public alarm. However, Richard Fuld never acknowledged that Lehman's fundamental business strategy was unsound, that the firm had engaged in perilous gambles for the sake of financial gain, that Lehman had obscured its losses through deceptive accounting practices, or that its leadership had disregarded cautionary signals, opting instead to increase their exposure to real estate when they ought to have been minimizing it. Hank Paulson also faced scrutiny. Why had he intervened to rescue Bear Stearns and AIG, yet allowed Lehman Brothers to collapse? Paulson maintained that he lacked the legal authority to assist Lehman without legislative approval. Nevertheless, critics highlighted that he found a legal basis to support AIG just one day later. The reality is more intricate. Paulson intended to convey a message that government bailouts were not automatic provisions. He aimed to establish accountability for reckless risk-taking, and he designated Lehman as the critical point of resistance. However, Paulson underestimated the profound interconnectedness of Lehman with the global financial architecture. He believed Lehman's downfall would be contained. He assumed that markets had a 6-month window, dating from the Bear Stearns incident, to prepare. He was mistaken. Lehman's insolvency unleashed a chain reaction that almost annihilated the entire financial framework. The credit rating firms Moody's and Standard & Poor's also bore responsibility. They had assigned top-tier ratings to mortgage-backed securities that were fundamentally composed of subprime mortgages of inferior quality. They received payment from investment banks to assess these securities, thus creating a conflict of interest. When the underlying mortgages defaulted, these ratings proved to be worthless. Regulatory bodies had failed. The Securities and Exchange Commission, the Federal Reserve, and the Office of the Comptroller of the Currency all had oversight over segments of the financial system. Not one of these entities foresaw the unfolding crisis, or if they did perceive it, they failed to take decisive action. And the financial institutions themselves, not solely Lehman, but Citigroup, Merrill Lynch, Bear Stearns, Wachovia, and Washington Mutual, all engaged in similar imprudent speculative ventures. They heavily invested in subprime mortgages and intricate derivative instruments because the profits were substantial and the perceived risks seemed remote. The entire economic structure was designed to privatize gains and socialize losses. Corporate executives amassed hundreds of millions during prosperous times. When conditions deteriorated, taxpayers shouldered the financial burden. Lehman Brothers represented the most prominent collapse. However, it was not an isolated incident. The entire financial system was fundamentally flawed. Here is a depiction of the events that transpired following Lehman's demise. Within a fortnight of Lehman's bankruptcy, Washington Mutual, the largest savings and loan institution in the United States, ceased to operate. It was taken over by regulators and subsequently acquired by J.P. Morgan. During this period, Wachovia, another significant financial institution, teetered on the brink of failure and was purchased by Wells Fargo. Merrill Lynch, which had been salvaged from insolvency through its acquisition by Bank of America, reported losses amounting to $27 billion in the fourth quarter of 2008. Bank of America required a second government bailout to finalize its merger. Goldman Sachs and Morgan Stanley, the last two independent investment banks, transitioned to the status of bank holding companies to gain access to emergency lending facilities provided by the Federal Reserve. The traditional investment banking model was effectively obsolete. Congress enacted the Dodd-Frank Act in 2010, representing the most sweeping financial regulation since the 1930s. This legislation established new supervisory agencies, mandated increased capital reserves for large banking entities, and aimed to prevent future government bailouts. Nevertheless, critics contended that the law did not go far enough, and financial institutions have spent the past 15 years actively lobbying to diminish its impact. Not a single high-ranking bank executive faced imprisonment. Richard Fuld was never subjected to criminal charges, nor were the chief executive officers of Bear Stearns, Merrill Lynch, Citigroup, or AIG. Certain firms incurred fines, totaling billions of dollars collectively, but these penalties were paid by shareholders, not by the executives responsible for the decisions that led to the crisis. And here is the most crucial observation. The financial institutions that weathered the storm became even larger. J.P. Morgan absorbed Bear Stearns and Washington Mutual. Bank of America acquired Merrill Lynch. Wells Fargo purchased Wachovia. The issue of institutions being too big to fail, which precipitated the crisis, actually worsened in its aftermath. As of the year 2025, the four largest banking entities in America, J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup, collectively manage assets exceeding $10 trillion. This figure represents 40% of all banking assets within the United States. They are now more extensive, more complex, and more interdependent than they were in 2008. The system that led to Lehman Brothers' destruction was not dismantled. Rather, it was rescued, consolidated, and expanded. September 15, 2008, marked not only the collapse of Lehman Brothers, but also the moment the world realized the financial system's fragility was far greater than previously comprehended. Lehman Brothers faltered due to its imprudent investments in real estate, its reliance on excessive leverage, and its obfuscation of risks through sophisticated financial maneuvers. However, Lehman was not an anomaly. Every major investment bank engaged in similar practices. Lehman simply succumbed first. The government permitted Lehman's failure to serve as a deterrent against moral hazard. Yet this collapse nearly jeopardized the entire global financial infrastructure. Within days, the government abandoned this principle and provided financial assistance to AIG, Citigroup, Bank of America, and numerous other entities. The pivotal lesson from Lehman Brothers should have been the imperative of preventing banks from growing so immense and interconnected that their failure poses a threat to the entire system. Instead, the takeaway for Wall Street was that if an institution achieves sufficient size and interconnectedness, the government will intervene to rescue it. The key is simply to avoid being the first to falter. Lehman Brothers was sacrificed to make a political statement. Subsequently, the government allocated $700 billion to bail out all other institutions. 158 years of operation, $639 billion in assets, and 25,000 employees. all vanished in a single weekend because executives pursued profits. Regulators looked the other way. Credit rating agencies misrepresented risks, and politicians delayed action until it was too late. Lehman Brothers did not fail due to a market downturn or an external shock. Its collapse was a consequence of avarice, excessive leverage, and systemic corruption. Furthermore, the conditions that led to Lehman's undoing persist to this day. Banks are larger, leverage is increasing, and the real estate market is overvalued. The commercial real estate sector is presently confronting a crisis, with loans totaling $1.5 trillion set to mature by 2026. Regulators are relaxing the stringent measures that were implemented following the 2008 crisis. The next financial crisis is inevitable. It may manifest in the real estate sector, in corporate debt, or in sovereign debt. However, its arrival is assured because the underlying systemic issues were not resolved. They were merely masked by central bank monetary expansion and government assurances. When the next crisis unfolds, will the government again provide bailouts to the financial institutions? Or will they allow one to fail to make a point, much as they did with Lehman Brothers? If this explanation has illuminated the events of 2008 and their enduring relevance today, please subscribe, as the collapse of Lehman Brothers was not a conclusion but a harbinger. The system that led to Lehman's downfall remains operational. Risks are continuing to accumulate, and the next collapse could be even more devastating. The warning is inscribed in the wreckage of Lehman Brothers. The pertinent question is whether anyone is paying heed.